I more so like gold over everything else. January is a very good barometer of if the monthly candle closes positive for January, it's usually a strong year for equities or a positive year. I think gold is going to hold its ground fairly easy. It's just getting hit with a wave of panic and some selling today. I think we're going to start to see it kind of rise from the ashes. It's still putting in a big base. But when we do go into a bear market, that's when we'll move to an inverse ETF. So as the stock market kind of plummets, we'll be able to benefit from the falling pricing. We are drooling over a market correction. We want the chaos to hit.
Chris Vermeulen, Chief Market Strategist for thetechnicaltraders.com. It's a true pleasure to host you back on Palisades Gold Radio today.
Hey, thanks for having me. Always a pleasure. It's great to be here.
Excellent, Chris. Similar to last time, I would love to get started talking about the precious metals complex. As you well know, gold's up close to 70% year to date, silver and platinum close to 150% year to date. However, today, the 29th of December, we are seeing a pullback, down about 4% on gold, down about 6.5% on silver. What are you making of the recent trading action that we have been seeing in precious metals? And what is your outlook, Chris?
Yeah, well, there's definitely a lot going on in the precious metal space, and it's not just the precious metal space. There's a lot of things outside of it, I think, that are warning us that I think we're getting close to an economic top. I think we're getting very close to a precious metals peak as well, and an equities market peak. So, you know, the volatility that we're seeing today in precious metals, which is December 29th, we've got gold down 4%, which is a huge move for gold. Silver's down over 6%. We've got platinum and palladium like plummeting. We've got platinum from the highs of this morning down 20% for palladium. And I actually think platinum almost as well. So we're seeing this big volatility. We saw this last week as well. We saw about a 12% reversal in platinum and palladium. And those are all signs. When you see a 10 or 11% rally followed by a 12% sell-off and then a big rally again, that's usually the sign of exhaustion. That's the bulls and bears. It's greed and fear. It's the sign that things are getting unstable. When things become unstable, they usually resolve to the downside. So we got to be very cautious here. The sentiment is very strong. Everybody's super bullish on precious metals. Everybody's, you know, all-time highs for everything. So, you know, it's hard not to be excited. I get more nervous when we see this price action because this is like, okay, maybe this run is over. Maybe I thought we were going to actually see metals pop up. Well, silver did hit our $82 target this morning, and now it's reversed and got hammered based on a Fibonacci level. But overall, I'm kind of hoping we're still going to see metals try to recover and go higher. But the volatility that we're seeing over the past more or less 4 or 5 trading sessions are telling us that there might not be much left. And this is the problem when we're in a little bit of a bubble phase is the market could still pop and rally the precious metals another 20, 30%. They could also drop 10 or 20 or 30%. And that's what makes it unstable and volatile and carries a risk. So it comes down to how do you manage your positions and risks so you don't take a big hit if it reverses. So that's where we're in right now. Everybody should be on high alert, as excited as we want to be and see gold over 5,000 and silver break like 100 or something like that. Those are some sweet dreams. They may happen, but you got to have a strategy in case it doesn't, right?
No, definitely. And Chris, the last time we spoke, you mentioned you have this thesis of one last parabolic phase higher for the precious metals complex. Is that something that you think is still the current thesis that will still happen?
Yeah, I mean, I believe we're in it right now. Like I'll share my screen and I'll show you kind of this last parabolic phase that I feel like we are entering in. So if we take a look at the left chart. Now the left chart, the candlestick is the S&P 500 weekly chart going back to the 2007 stock market peak. The yellow line is gold. And my expectations leading up to really last week was I believe we'd see the stock market start to sell off because the stock market did sell off about 20% in 2007 and the beginning of 2008. And we saw all that money come out of stocks and move into precious metals. Now, when we fast forward and look at where we are on the right-hand chart, that's where we are today. Very similar. Both gold and stocks have rallied. The thing is, we're seeing precious metals really pop and take off, and we haven't seen the stock market pull back. And I think a big chunk of this has to do with the Magnificent Seven, the big techs, the AI kind of bubble holding the value up and not giving us this downward move so much to feed into precious metals. And so that's where there's a big disconnect. And if we were to look at a lot of these different charts, if we look down below on the left-hand side, we got the gold and silver miners index. We've got silver, we got platinum and palladium. Well, last time we saw them all have this great big spike and peak as the stock market sold off and gold rallied. Well, if we look at where we are right now on the right-hand side, we've just had that big, huge peak and this blow-off top, it feels like. And the reversal price action we're seeing now feels like maybe the top is almost in. And so, as you just mentioned, I talked about how there's one last push. Well, that one last push has more or less happened over the past 3 or 4 weeks. And things have really taken off. I think gold might hold its value and push a bit higher. Well, maybe the more speculative metals like silver, platinum, palladium, and miners might pull back. But I think we may have just had that, and that's the big question: is do we have a high volatility, some big pop and squeeze to the upside, or did we just see that more or less in the last week, and now we're starting to see that reversal because the weekly charts are showing some huge selling going on, very similar to what we saw over here when they put in a major top, and they all sold off. We saw gold, silver, miners, platinum, palladium. They sold off pretty much all over 60%, most of them 70% from this phase. And of course, it was at a time where nobody thought metals were going to fall. You know, the dollar was beat up. It was very low, very similar to what we actually have right now in the markets. So I'm a little concerned for the precious metals space. I hold a lot of physical metals, and now I'm on high alert of, okay, we need to watch this closely, because if it doesn't recover, and it continues to show high volume selling and bearish price action on the daily, weekly, even the 30-minute chart, I might be moving away from the precious metals space because we could go into a bigger correction. But that's obviously not the mass psychology. Everybody is probably going to buy this dip still and hope it's going to go a lot higher.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. I guess if you have a large physical metal position, the hard part is these moves downwards are very rapidly. So you kind of need to be quick on your feet if you want to time the top accurately.
For sure. But the thing is, it's not about picking a top, right? Like we all wish we could sell near the top, but the problem is you do need a sharp pullback. You do need price to start to build a bearish price action and start to actually for the trend to reverse. You're not going to get out at the top. You're going to let price is going to pull back. It's going to start to head lower. The trend is going to change. And then you're like, okay, now the trend is down. I need to get out, right? So as much as we'd all love to get out at a peak, you are always going to give back that top kind of pop and drop price action. You just have to know that that big final rally and then sharp reversal isn't really yours to be had unless you're a trader and you're trying to pick a top and bottom, which is a loser's game in the long run. So you have to just accept the fact that, hey, silver popped to 12%, the previous session, and it gives it all back the next session. That wasn't really yours. That's just the price action that's telling you it's topping, and you're probably going to get out still a little bit lower as price breaks down and shows a bit more weakness. So I think that's where a lot of people get confused. They naturally think they should be getting out near a high. They don't want to sell as it has a sharp pullback and starts to reverse. But actually, that's just the beginning, because if you don't get out, these markets can sell off very, very dramatically. You look at silver down 61%, platinum down 67%, palladium sold off over 70%. So you got to be very cautious. Even miners on average sold down almost 70% as well. I'm not saying they're going to pull back that much, but we're in a similar situation in terms of what price action and sentiment across the board. It's almost mirroring like it did in 2007. And there's a really good, I think, example here. that I like to show because a lot of people don't quite grasp this. So let's just step back and look at the QQQ. This is the tariff sell-off this year in February, March, and April. Now, a lot of people said this was, very unique. It was tariff driven, which it was. But when we look at this price action chart, this is my strategy. It tells us when the momentum has changed, when selling has kicked in. We're able to avoid the market and profit as it goes down. We can re-enter at a new lower price and ride the next trend. But this is where I want to explain the precious metals space. People keep saying, Chris, this is nothing like 2007 for the precious metals space. This is a totally different game. Well, if we take a look at this next chart, the top one is the tariff of this year. The bottom one is COVID. They're almost exactly the same. The stock market moves based on fear and greed. And it doesn't matter if there's tariffs and people hit the sell button, or if there's COVID and they hit the sell button, or if there's a financial crisis and they hit the sell button, or a tech bubble. The sell button is the sell button. It's people dumping shares, it's fear. And when they buy, they all buy the same thing. So it's better to follow price action, and who cares what the news is? I trade pretty much without news. It doesn't factor into anything we do. Price tells us everything. That's how we make money as investors. Just follow price. If it's up, own it. If the trend is down, get out, find something else or profit from it. And so this is the big scenario of what people need to realize. Yes, 2007, totally different in terms of economic climate, what's going on in the precious metal space. But in the grand scheme of things, it's the same type of thing. And if you look at these bull and bear markets, this is the S&P 500 monthly chart. The tech bubble fell 50%. The S&P 500 fell 57%. Both of them are pretty much the same thing. Just some take years, some take maybe not as long to reverse. But cycles are the same thing, and we can track the market. We can identify when there's a bull market, when there's a bear market, a bull market, bear market, and that's what people need to understand. And when we take a look at the Benner cycle, which maybe you and I get into later, we are coming into 2026, which is actually a similar cycle as 2007. And we're coming into a time where you're supposed to be locking in profits across the board in any asset, in almost every asset, real estate, stocks, precious metals. We're going to see a lot of things take place. So there's a ton of stuff unfolding right now that people need to be aware of. And the precious metal space it's easy to get sucked into it, especially if you just tune in to precious metal bulls. They're always going to paint the bullish story that silver and gold's going to go to the moon straight up here, and this time is different. It's always, everybody says the same thing every time, but really price is price. If it keeps going up, well, you're going to hold it. If it does reverse, you're going to have a strategy to get you out, protect you, and then reload when the time is good for a new entry. That's the way I navigate the markets here.
Chris, you mentioned earlier that the bearishness in the general equities, S&P 500, hasn't really come in yet. Is that an indicator that you're looking for to predict when you think this cycle for precious metals finally ends?
Yeah, I think when the equities market does start to roll over and sell off, I think that's when we're really going to start to see the overall precious metals and miners sell off in a fairly big way. Actually, the best chart I think of this is, well, the QQQ is a good gauge, but also the Magnificent Seven. So if we look at the MAGS ETF, this is the basket of the Magnificent Seven. If this starts to break down, if it starts to break this low over here or this low, especially this low, we're going to see everyone from mass psychology, everybody who's piled into the Magnificent Seven, we're going to start to see them selling. And when they all pile in, we see big money, we see the stock market go higher. When they all start to flee and retreat and run for the exit door, we're going to see this sell off very precipitously because it's an emotional herd psychology kind of play to the upside. It's a crowded FOMO play. And of course, when it sells off, it's going to become a pure fear-driven move where people don't care what price they get out. And a really good indicator here is just look at the volume on the bottom here. Look at the big volume spikes. They're red volume pretty much all the big volume days. That's telling us there are some big institutions and big players starting to lighten their load. They're getting out of these. They're rotating out, putting the shares into the average investor who still thinks this market's going to go a whole lot higher. And eventually, when this market breaks down, the equities market is going to, I think, trigger, it's going to lead the economic data. So generally, we see the stock market top first. And a good example of this is if we just scroll down to the market cycles here, we naturally see this blue cycle top out. That's the stock market tops out first, because investors can see reducing sales and profits and earnings and all that. And then once the stock market starts to sell down, then suddenly the yellow cycle, which is the economic cycle, it eventually tops. And we start getting, bad GDP numbers, we see earnings and downgrades, all that happen, and all of that stuff. So we're in this sweet spot right here where precious metals are on fire. Energy stocks are holding up near all-time highs when we look at like OIH and things like that. Industrial capital goods, factories are super bullish, thinking this market is going to keep going. They're all buying equipment. These are all the signs that people are blind. They don't see what's going on, and the stock market is going to put in that top. And so that's what I am waiting for. I'm waiting for the stock market to crack and break down on the Magnificent Seven, on the S&P 500, the NASDAQ. Once that breaks down, the big question is, how low do we go? Is it a 20% correction, a 40, a 50, a 60? Obviously, it'll vary depending on the indice. If it's the S&P 500 or the NASDAQ, which the NASDAQ will be much more volatile.
All right, Chris, I would love to talk about some of these setups or asset classes that you are seeing that are showing a very interesting, setup to potentially take up a position in. What are you currently seeing? What are some great opportunities out there?
Yeah, I think right now believe it or not, it's still the equities market is still in an uptrend. So when we look at the SPY, all the moving averages are sloping higher. I think you still need to be long equities. I think equities are still to play. Now we're coming seasonality into a very choppy condition. January is a very volatile time. If we look at the seasonality of the S&P 500, right now we've had this holiday squeeze. We had this nice rally over the past week and a half in the equities, and now we're in this last couple of days of the year where it's going to be a little choppy. But it does show January is usually really choppy. And January is a very good barometer of if the monthly candle closes positive for January, it's usually a strong year for equities or a positive year. If it closes negative, it's a very bad sign for stocks for the year. And so a lot of people, I think, are going to be waiting for that January to see where we go. And we're about to walk into a volatile time. So I still like equities. I do feel like they're coming close to an end. I still like precious metals. I more so like gold over everything else because gold, when we look at this chart of gold, it's having a one-day pullback, but it's also a very emotional kind of pullback into a support level. So I think gold is going to hold its ground fairly easy. It's just getting hit with a wave of panic and some selling today. When we look at silver, it's down about 7%. It obviously has a pretty big reversal looking bar. It rallied 13% from the previous session. It's down 11% today from the high. If we look at platinum and palladium, so platinum's having a big reversal. It's down, what is it down today? It's down a lot. It's down 17% today. And then of course we've got palladium, which it's probably down even more now from when I kind of looked at this. So palladium from this morning's high to where its low is 20% today. So I don't like platinum, palladium, silver so much. Right now I still like gold. I like equities. And I do think, and this obviously goes against the grain, I like the dollar index. I actually think we're going to see the dollar index eventually have a nice pullback or put in a nice bottom here. It has had a big pullback. It's starting to put in a rounding formation. It's had a nice rally up. Now it's starting to pull back into support. And I think we're going to start to see it kind of rise from the ashes. It's still putting in a big base, kind of a stage one base and trying to figure itself out here. So I kind of like those plays. Other than that, I think cash is going to be a position that's going to be used quite a bit in 2016, where we can get in, we can catch a move in a specific sector or index or commodity. Potentially bonds come to life, TLT. But I think there's going to be a lot of pockets here where we move to cash, we collect interest while we're waiting for some setups. It's not about always being in a trade, and people always think you have to be diversified, you got to have a whole bunch of stuff and positions to make money. But when the market is not moving higher, the more positions you have, the more you lose. So if we go into a bear market, most assets go down. When we go into an economic reset, there is no real safe haven. And cash is one of the most powerful plays. It's much better to make one or say 4% on the year than it is to lose 34% on the year. You don't need to hold stuff and watch your money vaporize, right? So this is going to be the year of rotating between, I think, stocks, bonds, currency like the US dollar, and a cash position, and then doing, adjusting our precious metals play as we go, maybe moving out of those or not. But there's not a whole lot that I like. I think gold and stocks have a little bit of upside, and then we'll be moving out, and potentially the dollar or a cash position could become a temporary play. But when we do go into a bear market, that's when we'll move to an inverse ETF. So as the stock market kind of plummets, we'll be able to benefit from the falling pricing, which is a pretty epic feeling. But bear market ETFs and inverse ETFs really only work well during a bear market. And so we need a lot of damage. The stock market needs to break down in a big way, probably 15, 20% from here before it even triggers a true bear market in the scenario that we look to trade.
Thank you for taking us along there, Chris. I would love to get your take on oil and gas for a second. It's currently trading around $60 for Brent, below $60 for WTI. Has that been enough bearishness to entice you in?
Yeah, I'm definitely bearish on energy. It's been bouncing bottom here over the past week and a half, trying to figure out what it's going to do. But the big picture of oil, when you zoom way out, the trend is clearly down. I think the fact that oil has been moving down is a barometer that I think underneath the hood of the market and the economy, things are slowly starting to slow down in terms of sales and economic kind of growth, all of that stuff. So I think we're going to eventually see this break down, and I think it's just a matter of when. I think once oil does break down, we're going to hit that probably $45 per barrel mark fairly quickly, which is going to take the wind out of the sails for, I think, a lot of economists will probably start to be like, oh, maybe things are slowing down, and oil is a good barometer of that. So I do think we're going to start to see people become more bearish on the economy once oil breaks below this level. And again, I think it's a leading indicator that oil's been telling us for a long time. It's interesting because if we kind of put these two symbols together here, take a look at the energy stocks here. I'm just going to zoom way out. It's hard to see here on this chart, but more or less we have seen oil moving down. We've seen oil moving down for a long time, and of course we've seen energy stocks. They moved up, and energy stocks are still trading really high. This chart doesn't give a good example of it, but energy stocks in general are trading up very high. Same with XLE, which is the energy sector ETF. So oil and energies have been going down, and we're seeing the energy stocks still holding their value. Natural gas obviously has helped push some of these. There's been a big move in natural gas. If we take a look at natural gas, we've seen a very big pop. Very big pop in natural gas. Is trying to figure out what it's going to do. So anyways, natural gas has had a very big rally. It's helped hold the energy sector space higher, and I do think natural gas will eventually fade back down. There's this kind of big 4-year cycle that happens in natural gas, and I think we just kind of had one of those highs. So it means we're probably going to fade lower with natural gas, and of course oil moving down. All of this stuff, I think a pullback in precious metals, a pullback in energy, the economy, most people see this as a bad thing. But if you actually have a strategy and a game plan, you see the opportunity. This is like my subscribers and I, we are drooling over a market correction. We want the chaos to hit because not only can we avoid it, but we can profit from it. And if you can keep all your capital, keep your account values up and grow it as everything collapses, when the new major bull market starts, you have all of that capital to move into all your favorite things. That's when you can pile into precious metals and miners again, where I think they're going to rally for many, many years. This pullback I'm talking about, I think is going to be fairly swift. I think it'll be like a 1 year or 8 month pullback in precious metals and energy. It'll be that tiny window to get in and pile into precious metals and miners. And it'll be a great opportunity, I think, in the long run to get back into equities and dividend paying stocks when they're actually fairly valued and they're paying higher dividends compared to the share price. Plus you get the upside. Real estate's going to be a great opportunity as well. So this is all really good. I mean, people don't want to hear that precious metals might be topping and showing signs, but it's actually a really good time for it to happen. I think I've been talking about this for about 1.5 years, that I think we're going to see equities top out. It's going to pull precious metals down for that last amazing opportunity to pile into metals and miners. And then they're going to be to the moon, like $7,500 gold and beyond, and probably $100 silver. But I think we're about to hit a roller coaster ride that for some reason a lot of people don't want to see coming or don't want to think about. But that's just part of the ride.
No, definitely. When you look at historical parallels, for example, the 1970s for the precious metals complex, you saw pullbacks of about 50% a couple of times for gold.
Yeah, huge pullback. Same with silver. You look at the monthly chart of silver. If you zoom way back, back into the 70s, we're having the same type of thing, a straight up parabolic spike, and it comes straight back down. I think this time, silver is going to pull back, maybe not all the way back down. I think it's going to try holding around $45 to $50. I think that'll be the new floor. And then from there, I think it'll ratchet itself higher over the next 5 or 10 years dramatically. But I do think it's going to have a very sharp pullback.
All right, well understood. I would love to take you back to oil for just a second longer. I believe I asked you this last time as well, but what would you need to see in oil and gas to become bullish on the sector?
It generally comes down to price action first. So we need to start seeing some higher highs. So breaking some previous highs from a few months ago. Obviously some higher lows. So the definition of an uptrend is a series of higher lows and higher highs. That means it's channeling and trading higher. So that's the number one core thing. I would also want to see energy stocks probably being strong and breaking out and moving up. That usually means that some insiders and big money see upside potential, and usually smart money moves into energy stocks just before or as like oil starts to move higher or break up. So that's the main thing I'd be looking for. It just comes down to price action. But when you look out on the big charts from the daily, the weekly, the monthly, it's really a series of lower highs and lower lows, and we're really just, that trend needs to turn around before I become bullish. But it could do it very quickly. It really could. As we know, the markets can turn. We can have crazy things happen you never expect, like negative pricing on crude oil, or we can see things skyrocket higher. So anything can happen. That's why you just need to have a strategy in place so that if it does happen, you're like, okay, well, that just changed the outlook. That changed everything. And then you just have to change gears. But you have to be able to move in and out of something, not fall in love with it and be stuck with it. I really always think the second you put your money into a trade, into a market, into a commodity, it's trying to take your money. It's emotionally trying to rob you, to make you put a trade on to get out of it for a loss or something. And so I look at every trade or investment as a risk, as a threat. It's the market is going to try to put me through the ringer to try and get me out of that trade. And so I move in and out using technicals, and I don't fall in love with something. And that allows me to avoid some of those big roller coasters. I just get back in later. Could be at a lower price, could be at a higher price. I don't care. I just don't want that middle high volatility roller coaster ride. And I don't want to waste 3 months or 3 years in something not actually moving. I'd rather just put that money elsewhere and then get back to my favorite precious metal space, when it's primed and ready for another big run.
Chris, how are you thinking about volatility heading in 2026? When we look at the VIX index currently, it's trading close to a 52-week low. Is it an interesting play to, play these banner cycles that you outlined earlier, for example, through a call option on the VIX, to, get exposure to this and potentially benefit from increased volatility?
Yeah, I definitely think 2026 is going to be a huge volatility year. I think it's going to be life-changing for a lot of people. It's either going to be amazing or it is going to be a bloodbath, depending on how you navigate it and attack it and what you expect. The VIX, it's a tough play. We have an options trading service. We don't usually just buy calls. We usually write sell options. So we benefit from a decline in volatility or can do something where we can benefit from even a rise in volatility. I do think the VIX is going to have some huge rallies this year. The fact that you just mentioned the VIX is very low, that is a warning sign. The saying is when the VIX is low, it's time to go. When the VIX is low, it means there's no fear. And people aren't afraid of equities right now. People aren't afraid of precious metals. Those are all warning signs. And, sentiment is one of the strongest tools. I have a few custom sentiment indicators that I've built that are unbelievable for timing short-term moves on the 30. 30-minute chart and also bigger term moves, which take much longer to unfold. And we're getting into that phase right now that the sentiment right now is, I'm very bearish on 2026. We have a lot of major stages and cycles, and even the Benner cycle, which is saying that 2026 is going to be a very tough year. Now, it usually says 2026 will be at the end of the year, but if you look at how all of its other cycles happen, it could be plus or minus a year, really, either side. So it's not to look at something and nail it down, saying, this month we're going to see the market top. It's like, no, sometime in 2026, things are going to reverse, and we're probably going to see bad news come out that's going to probably create a breakdown in oil. It's going to create a big sell-off in the AI space. But overall, just expect big volatility this year.
Chris, I would love for you to quickly talk about the technicaltraders.com to us.
Sure, yeah, the technical traders. So more or less every morning, I share my charts. I go through the intraday charts, all of our positions of what we're in. We recently traded silver. We got out of silver for a nice 20% gain in a few days. We got out of a gold 15% trade. So I manage my own portfolio. Every morning I do a video. I share what I see in the markets, how our positions are, how to be mentally prepared. Is there going to be a gap higher or a gap down? Is there panic selling or FOMO buying? If there are those, I try to explain, most members feel those emotions. I have tools to identify, and so I help soothe people. I kind of hold their hand as the market tries to shake everybody up. And so we just invest together. You copy the same portfolio positions I do. I trade only ETFs. I keep it very simple. We have 1, 2, or 3 ETF positions open at a time. And we navigate through equities, bonds, precious metals, the currency, and we move to cash. We just kind of rotate through those. Very simple, very straightforward. We have 5 to 12 trades a year. We can manage portfolios from 100K. We don't manage money, you manage your own. But the strategy works best for a $100,000 portfolio up to 5, 10, 15 million. It's designed for big portfolios to keep the volatility down so you don't have to have huge swings, and you can profit from falling markets.
Chris, thank you so much for your time and your insights today. Really appreciate it.
Hey, thanks for having me. Always a pleasure, and Happy New Year's.
Happy New Year's.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.